The economy, February 2014. It seems that the U.S. economy got a little ahead of itself last year. Real consumer spending rose in the fourth quarter at the strongest pace in 3 years, but January's report suggests that such a pace will be tough to maintain in the first quarter. GDP growth now expected to be settling back near 2.4% rather than the 3% annualized gain that we saw in the second half of 2013, and although fundamentals remain strong, there are headwinds in the first quarter of 2014. Employers added only 113,000 jobs in January and 75,000 jobs in December, making it the weakest stretch of job creation in the last 3 years. National unemployment stands at 6.6%, partially due to the fact that the labor force participation rate has declined to 63%, well below the level last year and near its lowest point in the last 35 years. This past month's disappointing economic news and pullback in the stock market have raised fears that the gradual reduction of the Fed's monthly securities purchase is sapping the economy's momentum. The transmission mechanism is weakening currencies and raising interest rates in some emerging markets, which is stoking fears that the global economic growth may not pick up as much as hoped. A mix of economic data shows that exports, vehicle sales, pending home sales, manufacturing, travel statistics, and consumer spending are all on the decline again. Worries about emerging markets also sparked new doubts about the global recovery, and uncertainty surrounding fiscal and monetary policy is on the rise again as it relates to job creation, capital pricing, and more. The biggest market risk today is trajectory of interest rates as the Federal Reserve fades out its economic stimulus plan, reducing the monthly purchases of Treasury securities from $85 billion per month by $10 billion every month. On the other hand, even though the 10-year Treasury rate is expected to reach 3% in 2014, most economists believe that the Fed is very unlikely to raise interest rates before 2015 because the economy is still in a delicate recovery. Capital markets. The availability of debt and equity is on the rise in 2014 as sources are looking to increase their allocations and look at investments they have previously avoided, such as secondary and tertiary markets or less perfectly positioned assets, as they become more comfortable with the improving conditions in the market. Equity is expected to come from wealthy investors, institutions, global investors, sovereign funds, REITs, and family offices. Debt will come from insurance companies, banks, mortgage REITs, global funds, mezzanine lenders, and CMBS that will rise to the top in 2014 with expectations for more than $100 billion of new originations. Interest rates are expected to rise in 2014, but it is widely believed that the market can handle it without serious disruption thanks to greater demand and projected income growth through rising occupancy and higher rents. Commercial real estate. Commercial real estate is reaching the point that valuations are no longer driven by capital markets. Market fundamentals and property enhancements are becoming the primary drivers of total return. Investors continued their search for yield in 2013 as fundamentals improved. Cap rates continued to compress nationally and in certain markets, exceeding cap rate lows previously seen in 2007. As supply of quality properties runs low and the cost of capital increases, investors reduce their risk premium and accept lower spreads between the cost of capital and their total return. As spreads decline, they are still near their 10-year averages, showing continued attractiveness of the risk-adjusted returns of commercial real estate. Demographic changes will continue to positively influence real estate trends thanks to the growth of the millennial generation, which is almost as big as the baby boomers generation. The technology demand from this generation will also become a game changer and will positively impact retail and industrial real estate. Along with job growth, the activity in the retail and office sectors is expected to improve, and the prospects for new mixed-use development are increasing again. Everyone is looking to move back into the cities. The population in the U.S. is growing at about 3 million people annually, so as far as the retail sector is concerned, the demand for the average retail store is not going away anytime soon. People will still need their hair and nails done. They will continue to shop for groceries, drugs, dry clean their clothes, and go out to restaurants. Malls, mixed-use projects, and entertainment centers that can offer a place to hang out and socialize will continue to thrive. One issue that remains a significant concern for commercial real estate is the tax reform proposal. If passed, the implications could be huge. One issue that remains a significant concern for commercial real estate is the tax reform proposal. If passed, the implications could be huge. First part of the reform will be the extension of the depreciation schedule that will allow a smaller amount to be depreciated every year. In addition, the tax payment on the amount depreciated will increase from a flat 25% today to a regular income tax level. The second part of the reform aims to reduce or completely eliminate 1031 exchange benefits. This could be devastating for small investors and single-tenant retail properties that rely heavily on these advantages. It is estimated that more than 30% of all commercial properties transactions under $15 million are completed by using 1031 exchange, and therefore transaction volume may reduce dramatically if these reforms are approved. If you are the type of person who never calls his congressman, today may be a good time to start. National Retail Outlook. Retail has been slower to recover than other asset classes, but with the expectations for improved GDP and employment growth, retailers are expanding again, but technology and e-commerce is changing their space requirements. The need for big box department stores is diminishing rapidly. Retail will continue to converge with online shopping as more and more retailers are getting aggressive in their competition with Amazon and deliver goods on the same day and become a semi-fulfillment center to online purchases. Outlet centers seem to be the biggest beneficiary of the recession, with retail sales increase of 28% and the opening of 39 centers in North America since 2006. Single tenant is still on fire, but the cap rate contraction seems to be reaching a floor. One must keep in mind that in raising interest rate environment, asset classes that have longer lease terms that are 10 years or longer tend to be more vulnerable. Drugstores in particular tend to have flat leases with no rent increase for 20 to 25 years, and therefore they offer no protection against inflation. Among all retail property types, neighborhood and community centers are most highly rated for investment prospects for the next 3 years, as they have the greatest chance of experiencing value appreciation in the next 3 years. Rents and occupancy levels are on the upswing again thanks to a growing demand for space from retailers that are finally expanding again in a virtually no supply of new construction environment. Supply level is, in fact, at a 34-year record low and is expected to remain low for the next 3 to 5 years. New development takes between 24 to 30 months from the drawing board to the groundbreaking, and rents are still not back to the level that justifies new construction. Retailers simply do not have the patience to wait that long. We expect rents to grow between 20 to 25% before any significant new development will start coming online. On the transaction side, a remarkable rebound in prices occurred for retail properties in 2013 as investors re-embraced the sector in 2013. The Moody's RCA CPPI for retail is expected to post a 23% increase for the year, well above any other property type. Sales of significant retail properties totaled $60.8 billion in 2013, up 8% from 2012. Sales of significant retail properties totaled $60.8 billion in 2013, up 8% from 2012. Sales of strip centers and single-tenant properties jumped 26%, with activity for regional malls failing to meet the surge of recapitalizations of 2012. Many investors moved further out the risk spectrum and started to pursue properties in markets that have lagged in the recovery. Volume in the non-major metros grew 23%, while activity in the 6 major metros declined 14%. The standout was unanchored strip centers, where volume surged 26% and prices spiked by 27%. The sector may have more upside as prices are still 32% below peak levels compared to the retail sector as a whole, where prices are now within 15% of peak. For comparison, prices for retail properties in the 6 major metros and for single-tenant retail properties reached prior peak levels in Q4 of 2013. Average cap rates in 2013 for neighborhood and community centers are 7.26% and 7.41% respectively, down from 7.6% in 2012. Another important indicator to consider is the spread between the discount rate and going-in cap rates. When it increases, the likelihood of a cap rate increase in the near future is higher. Neighborhood and community centers have the lowest spread among all asset classes, and therefore they are less likely to face an immediate upward pressure on cap rates. Distressed sales will continue for some time, but the volume of sales associated with distress accounted for less than 5% in 2013. Distress is no longer a significant factor weighing on the marketplace. Orlando MSA. Central Florida rebound is in full swing, and Orlando is leading the way. Cranes evidence the downtown recovery with new hotels, office and apartment projects are resurrected, as well as the Dr. Phillips Center for the Arts and a Major League Soccer stadium that are scheduled to open in 2014. Orlando is already the top tourist destination in the world with more than 56 million visitors per year, but expansions like Disney's Avatar and Magic Kingdom, Downtown Disney, and Harry Potter and Universal, Orlando's tourist visitations are expected to reach 63 million per year, adding more than 1.3 billion of new business annually. Lake Nona Medical City is home to Nemours Children's Hospital, UCF Health Sciences Campus, the Burnham Medical Research Institute, and the VA Hospital. It is expected to create more than 30,000 jobs and $7.6 billion in economic impact over the next 10 years. The Orlando International Airport is preparing for a $1.1 billion expansion, and the Sunrail light train will begin service in 2014, running 61 miles from Volusia to Osceola County and eventually connecting to All Aboard Florida, a high-speed train which will connect Orlando to Miami. The Sunrail project is expected to generate more than 261,000 jobs and $8.8 billion in economic impact over the next 30 years. While the severity of the downturn precluded a timely return to pre-recession employment levels, progress toward that end is substantial. At the current rate of job creation, though, it will not be long before Orlando joins the growing cohort of local economies in which current employment surpasses the pre-recession levels. Orlando is on track to be the first of Florida's 6 major metropolitan areas to do so. Total non-farm employment as of October 2013 was up fully 29,100 jobs, 2.8% from 12 months prior. The BLS reports an unemployment rate of 6.3% in September for the Orlando Kissimmee Sanford MSA, down from 8.1% 1 year earlier. The housing market, accordingly, has strengthened. Third quarter housing starts were up fully 51.9% year over year as 2,743 single-family homes got underway. The median sale price for October at $174,750 was up 28% year over year, the Orlando Sentinel reported in December. With its main pillars reinforced by the national recovery and the reinvigoration of tourism, as the return to strong job and population and growth and rising residential development activity suggest, there are good prospects for continued expansion in Orlando. Moody'sEconomy.com reports a third quarter 2013 average household income of $97,326 for Orlando. Average household incomes of $128,646 and $117,204 are reported for the top 10 metros in the nation and South Atlantic region, respectively. Orlando's investment prospects have improved significantly. The city is expected to outperform many markets in the nation thanks to a change in vacancy, rental rates, population growth, and unemployment. Orlando's retail sector is currently on the third stage of the recovery cycle, along with cities like San Diego, Salt Lake City, Sacramento, Los Angeles, Denver, Chicago, and Broward County, Florida. The shopping center market in Orlando MSA currently consists of 1,361 projects with 63,370,992 square feet of retail space. The retail sectors include community, neighborhood, and power centers, continue to see high vacancy rates as lingering effects of the recession and its impact on population growth and residential development. But with the economic ship righting itself, both sectors also see improvement. We expect community and neighborhood centers' net absorption in 2013 to stage its best performance since 2005. Moreover, construction remains constrained, lending additional impetus to the decline in vacancy. Thus, the delivery of 26,000 square feet of new construction to this sector through the first 3 quarters of the year was accompanied by 416,000 square feet of positive net absorption. The absorption total for the third quarter alone was 141,000. October also saw no new supply, added 44,000 to the year-to-date count. Since then, the 64,200 square foot Publix at Town Park Neighborhood Center, anchored by a 46,600 square foot Publix grocery store, completed in November in Northeast Orlando. Ongoing positive net absorption should drop the community neighborhood vacancy rate to about 12.5% by the end of 2013, with additional declines expected for 2014. Rent growth at about 2.5% is projected for 2013, with similar growth expected for 2014. Meanwhile, 198,500 square feet of space in 4 neighborhood centers were under construction per the date of this report, and the 108,000 square foot third phase of Orlando Premium Outlets completed in October in Southwest Orlando. Rent growth has improved at $17.66 per square foot and $15.14 per square foot. Asking and effective averages for the third quarter were up 0.2% and 0.3% for the period alone, but were up 1.8% and 2.0% year over year. Significant projects are brewing. The $100 million Plaza on University mixed-use project near the University of Central Florida reached a milestone in October with the signing of its first retail tenant, a sushi restaurant. The project is set to bring about 60,000 square feet of much-needed new retail space to one of Central Florida's hottest submarkets. Reese expects total retail development at the project to run to 134,000 square feet. Another $100 million project, iDrive Regional Center on International Drive in Southeast Orlando from Unicorp National Developments Incorporated, has finalized several deals, this source reported in November. Plans call for 100,000 square feet of retail, including outparcels. In addition, NBA basketball franchise Orlando Magic's planned $200 million downtown entertainment and sports complex will include a substantial retail and restaurant component, and a retail development on a large scale is planned for the airport. Power Centers, Orlando. Vacancy in Orlando's Power Center market also runs high at 7.6% in the fourth quarter of 2013. The national Power Center rate was 5.6%. At $24.60 per square foot, the mean asking lease rate for local non-anchor Power Center space was up year over year. Tampa. Power Center's vacancy in the Tampa area was 5.4% for the fourth quarter. At $23.91 per square foot, the asking rent for local non-anchor Power Center space was up year over year. Transactions and cap rates. Orlando. Retail real estate investment dollar totals have increased annually over the previous 3 years. Based on data for the first 3 quarters of 2013, another increase is easily possible. Sales volume of neighborhood and community centers in 2013 was $670 million, a 101% year-over-year increase. 40 properties traded at an average square foot of $135 and an average cap rate of 8.6%. Orlando is now ranked number 14 in sales volume in the nation, up from 46 in 2009. Tampa. Sales volume of neighborhood and community centers in 2013 was $368 million, a 73% year-over-year increase. 32 properties traded at an average square foot of $134 and an average cap rate of 8%. Tampa is now ranked number 12 in sales volume in the nation, up from 35 in 2009. Tampa St. Petersburg Clearwater MSA. The Tampa Bay economy continues to expand. While the recession here was deep and pre-recession employment levels have yet to be regained, recent job growth has been formidable. Indeed, bucking a trend common across the nation, job creation in the Tampa Bay area in 2013 was stronger than in the year before. According to preliminary data provided by the U.S. Bureau of Labor Statistics, the unemployment rate of 6.7% in September for the Tampa St. Petersburg Clearwater MSA is down from 8.5% 1 year earlier. Total non-farm employment as of October was up fully 39,800 jobs, 3.4% from 12 months prior. The gain for the preceding 12-month span was 24,100 jobs, 2.1%. These recent gains leave metropolitan statistical area employment 34,300 jobs, 2.8% shy of the pre-recession October high, which occurred as long ago as 2006. The broad base of job growth, including key sectors such as construction, leisure and hospitality, trade and professional and business services bodes well. Clearly, the local economy has regained its footing. Moody's Economy.com reports a third quarter 2013 average household income of $101,132 for Tampa. Average household incomes of $128,646 and $117,204 are reported for the top metros in the nation and South Atlantic region, respectively. In October, Amazon.com selected sites in the greater Tampa Bay region for the development, about 40 miles apart, of two of its large fulfillment centers. One will be built in the Ruskin-Riverview area, Hillsborough County, on the eastern shore of Tampa Bay. The other will be constructed in Lakeland, Polk County, to the east. The facilities combined are expected to employ approximately 1,400 permanent personnel and considerably more during peak retailing seasons. The housing market has revived. The latest data from Greater Tampa Association of Realtors for its area of coverage provides a mix of mainly favorable statistics. At $191,936 and $150,000, October's average and median selling prices were up 13.3% and 15.4% year over year. Inventory on the market increased by 2.9% to 14,113 homes, even as median days on the market dropped from 54 to 43. Tampa's retail sector is currently on the first stage of its expansion cycle, along with cities like San Jose, San Francisco, Philadelphia, and others. The shopping center market in Tampa-St. Petersburg currently consists of 2,163 projects with 87,888,885 square feet of retail space. With demand improving and development remaining subdued, vacancy in the community neighborhood center market should soon begin a gradual extended descent. Weak rent growth at about 0.5% in 2013 should be followed by growth at 1.5% to 2.0%, roundly stated in 2014. The robust retail construction trend of a few years ago, with its numerous large format projects in the Wesley Chapel area of north suburban Pasco County, has been followed by a marked decline in activity. Recovery trends in the local economy and the return of residential development and development planning, however, are bringing brighter prospects to retail. Still, construction of new projects remains subdued. The 2013 completion total for all categories of retail space combined will consist solely of 70,000 square feet in two phases of The Corner, a neighborhood center in Tampa's upscale West Shore area. Sabre Real Estate Advisors is the developer. March and December completion dates are cited for the two phases. In addition, a January 2014 start date is scheduled for the 120,000 square foot Cortez Commons Community Center in far northwest suburban Spring Hill, with the completion to follow in early 2015. Michael Collard Properties is the developer. While large-scale format retail development has focused heavily on north suburban Pasco County, as indicated, focus has shifted to the Riverview-Gibstonton area on the east shore of Tampa Bay in the Metro Southeast. Here, DiBartolo Development's Riverview Bell Plaza in Riverview remains under construction. Anchor stores by Sam's Club, Chase, and Walgreens are open at the project. The 142,000 square foot second phase of the Somerville Crossing Neighborhood Center broke ground in November 2012. Projects in the planning pipeline in this area include the 1.0 million square foot South Shore Commons Regional Center from Nationwide Realty Investors. Construction, however, is not yet complete in the north. Still in the pipeline is the planned 450,000 square foot second phase of Benkar Properties' 835,000 square foot Grove at Wesley Chapel Regional Center, and the Cypress Creek Town Center, now likely an outlet mall and also in Wesley Chapel, remains on the list of planned projects. In November, the developer Simon Property Group and E. Jacobs Group finalized a permit with the U.S. Army Corps of Engineers toward its development, the Laker Lutz News reported. The project now must go before Pasco County for the site plan approval. Meanwhile, the community neighborhood center market shows muted progress, while net absorption year to year through the third quarter alongside 35,000 square feet of new space was negative at 32,000 square feet. The total for the second and third quarters together was positive 62,000. The third quarter total was 40,000. Vacancy ended the third at 11.8%, same as a year earlier, at $14.32 per square foot and $12.55 per square foot. Asking and effective average rents for the period were up 0.1% and 0.2% since mid-year and were up just 0.6% each year over year. Favorable absorption in October, however, knocked 30 basis points from the vacancy rate, while each mean rent grew by 0.2%. Third quarter power center vacancy, favorable at 5.4%, was down 40 basis points for the quarter, but was up 30 year over year. At $23.19 per square foot, the third quarter mean asking lease rate for local non-anchor power center space grew 0.4% during the period and was up 1.6% year over year. Sean Glickman, Managing Director of the Glickman Retail Group, is a real estate strategic advisor and a shopping center expert in Florida. We are experts in institutional-grade investment services. As your objective advisor, our primary focus is to help you make the most effective investment decisions. Working with our team, you will maximize the value of your assets and create wealth for you and your investors.